Testing. Sound good, Mike? Let me hear
Excellent.
you. All right.
What
I kind of had a.
me?
No, I had a flick. No, you're good.
Me.
I had a flicker in my AirPods just now. I was told that I better give some shout outs out to start this off, and I love to, so you don't have to tell me twice. In particular, I want to say hello to Cliff Peebles, Roger Weatherford, and Brian Grill, 3 of our regulars. We miss you guys when we're not on, and we appreciate you coming through for the live. Thank you guys so much.
Is Sam Bankman-Fried in the chat by any chance?
Sam's not in the chat, but you know who is? Bonjour to part-time Larry, who's telling us that he is in France now. Jay Luther, I see you. David, what's up? Gavin, got you. Who else? Nicole's bouncing around in the chat. Pam Hill is here. A lot of really, really great commenters. We're going to have a lot of fun tonight. We appreciate you guys for coming through for the live version. Michael, speaking of Sam Bankman-Fried, we've got a new sponsor tonight. Who is it? Tell us all about it.
Well, not brand new. FTX, buy, sell, trade, crypto, NFT. Listen, I'm still buying. I'm still bullish. I don't know what to tell you. Are prices going up? No, they're not. Can they go lower? Yeah, they probably will.
You know why I'm bullish?
What?
You know why I'm bullish? No, I am. Because I asked you to get somebody to help me move my account from Coinbase into our index product that we run for clients. And they were too busy to call me or help me. So if this was a real bear market,
false. It went to voicemail.
Well, you knew it would go to voicemail because I don't have voicemail set up.
You know where I am going to be watching FTX tonight, kind of. You know where?
What do you mean? Where?
They own the rights to the Miami Heat arena.
That's true. That's very true.
I can't believe I'm rooting for the Heat, but here we are.
You are rooting for the Heat?
Am I rooting for the Heat?
I'm not. Hell no.
Let's see what happens when the game starts.
That's so weak. All right. Let's see why.
I don't know. I don't know what the heart wants what it wants. I don't know.
Who scores scores the first basket? That's who you're rooting for.
Marcus
the
Smart.
Series?
Marcus Smart, yeah.
All right, fine. We love Sam Bankman-Fried. We love FTX. Thank you for sponsoring. We appreciate it. You might not love every comment I make on tonight's show, but I'm confident Michael will clean it up. Okay. First things first. I'm going.
Who's you?
First
what you're talking? Are you talking to the audience or FTX?
I'm talking directly to Sam. Actually, okay. No, I don't know.
All right, speak your mind. Speak your mind.
I'm talking directly to the audience. Well, to me, this is like the biggest story of the week, and I try to lead off with whatever the biggest story is. This is like the type of market environment, economic environment, whatever, where it's not like amazing for anyone, but millionaires do better than billionaires. Do you know what I mean by that? Do you have any idea of what I'm talking about?
No, you're so smart. I have no idea. Please enlighten me.
No, like what I'm trying to say, maybe I'm not explaining it that well with one sentence. What I'm trying to say, I feel like you're more at risk of what's going on right now if you're a billionaire than if you're a regular millionaire. Most regular millionaires, it's a ridiculous phrase,
are not losing billions of dollars. I agree with you.
Well, no, obviously, but also are not heavily in the types of things that are now blowing up literally left and right. And look, the billionaires can afford to take these blow-ups, but I'm sure it still has to hurt. Like when you have a net worth go from $10 billion to $2 billion, you can't tell me, even though you still have $2 billion, you don't feel like a dick a little bit, or you're not angry at all. Gotta be.
Dude, Brian Armstrong was worth almost $14 billion in November.
What is he worth today?
2. That's a
$2 billion. That peasant
difference. What a loser.
Let's start with you got some charts.
Hold on, before we get to charts, hold on a sec. The CEO of Binance. Remember we were speaking about this on TCAF a couple months ago?
I was laughing so hard I could have.
You were actually laughing. His $96 billion fortune.
Yeah.
This dork is only worth $11 billion now.
Okay, first of all, bullshit that he was ever really worth $96 billion. You're not like really worth $96 billion if you can't get access to $96 billion.
No, that's
like
not
Buffett's
true.
Buffett's not really worth $50 billion either because he can't have it. I mean, that's just listen. I'm a street guy. Okay, I'm from the South Shore of Long Island. If you can't ever make it liquid and hold it, you can't. You don't have it. Like you have it on paper, but it's not yours. So Chang Peng, Chang Peng, who gives a shit? Nobody, because he's still gonna live like he's still gonna live like. All
right, so he's not worth 90 billion. He's worth 37. What the hell is the difference?
That's why it was funny to me. So he was worth 96 billion on paper, and they said he had the largest fortune in the world. On Wednesday, 5 months later, it's worth under 12. So, like, was it ever really $96 billion? Not quite.
Maybe because I don't have billions of dollars in crypto, and I'm not like a crypto native, that I'm not like freaking out about this. I understand that like the Terra shit was like obviously jarring and unfortunate for a million reasons, but just in terms of what's going on with Bitcoin specifically, throw up this logarithmic chart. I mean,
here you go, putting things in perspective for me.
No, I'm doing it now. The difference is the difference between now and all of the other events. Chart off, please. Is there are, I don't know, millions more participants in the market today than there were in 2015, 2017. There was nobody trading. So I think that chart is a little bit bullshitty. Because there's now it's a lot bigger market cap than there's now institutional investors. But next chart. So in terms of drawdowns, again, if you are not prepared,
yeah.
If your position size does not allow you to sleep through this, well then you were overexposed. So I said earlier that I was still buying. I am still buying. Do I think that Bitcoin can go to 10,000? Yeah, of course I do.
Can we address that?
I don't think it's going to, but I think it can. Why not?
So Bloomberg and everybody else led with the headline, crypto lost $1 trillion in 6 months. First of all, I think it's way higher because not everything is being reported on. But so what? It doesn't like
time out. You can't have it both ways. So Chang Peng, if I'm getting his name right, he wasn't really worth $96 billion, but now you're saying the loss is being underreported. So that's being overreported and this is being underreported.
Yeah,
Sir?
because I think the thefts. I think the thefts should be bundled in with the losses. All right, fine. You had this story about how they were trying to defend a stablecoin by selling how much 80,000 Bitcoin or some ridiculous thing, like literally selling
3 billion. They bought
$3 billion worth of Bitcoin. So now the fact that Bitcoin survived that I think is remarkable, and we said that last week. If that was a stock and not what it is, it'd be zero, like 100 times over. So I think that's a feather in crypto's cap. But what we should say, when they breathlessly report crypto lost $1 trillion in 6 months, the people that sold it like got something else in return for it. It didn't like disappear into thin air. It's just not in crypto anymore. It's in yen. It's in yuan. It's in dollars. It's in euros.
No, it's literally gone.
No, it's just not crypto money anymore. It's somewhere else. It doesn't like poof. It doesn't disappear. It's converted.
It's vaporized.
How? Explain.
What do you mean into what? There's no yen in Bitcoin. It's vaporized. It's gone.
No. If you sell Bitcoin, what happens?
What do you mean if somebody buys it? What do you mean?
Right. What do they give you? What do they give you in return?
It depends. If you sell Bitcoin, what do you get?
Yeah, stable coin, dollars,
USD, whatever.
Okay,
Whatever
so that's the point. So the value isn't gone. It's just not in crypto anymore. It's somewhere else.
Dude, when Apple goes from 2 trillion to 1.5 trillion, you saying the money goes somewhere else? It's gone.
Yeah, it goes into whatever people.
So you're saying money is finite? It doesn't expand and contract? Come on.
No, I know it expands and contracts, but if the reason why Bitcoin would drop $15,000 per coin is because people are selling it and getting something else in exchange. It doesn't just happen. It doesn't just drop in value and the value dematerializes.
It does. It does. It's wiped out. No, it's
wiped out of crypto. It's not wiped out, period.
What are you talking about? It's gone. It's not going into something. Oh, my God.
I'm sorry. Right. It is, though. But it literally is. but
No,
it
okay,
literally
fine.
is.
We'll get to that in a second. We have charts. But to your point about first of all, there's blowups everywhere. So if you want, like, you could compare like ETH to like all of the DocuSigns.
Time out. I agree, but wait a minute. Bank of America puts out a note saying that cash positions for professional portfolio managers are at the highest levels since after 9/11. That was today, right? That was the big news today.
So that's all the Bitcoin? It's all the Bitcoin going
No,
to cash?
it's stocks that they sold. They got cash back. So do you understand? The value has been wiped out of the stocks. Why wouldn't it be equivalent?
It's not because it's
How,
not. That's not
Sway?
how the math works.
All right, fine.
Dude.
All right, fine.
Honestly, I need somebody smarter to come on here and tell you why you're an idiot, because I'm an idiot too, because I can't explain it, but you're wrong.
It's probably not.
That's not how it works.
That's
not how it works. It's not dollar for dollar.
All right,
like
fine.
That I'm positive on.
What were we talking about? Oh, go to this orange.
Nope.
Go to this orange chart.
Okay.
What is this?
Yeah, we know.
So
This is from the journal, I think.
So some of this is so most of this obviously is Ethereum and Bitcoin. What's interesting to me here is that as Bitcoin and Ethereum drop, it appears just visually that the alternative coins drop even faster because their lines are getting slimmer. Is that the right way to say that?
Correct. So, all right.
Okay.
So Ethereum's down. Ethereum was in a near 60% drawdown. With high beta tech getting blown up all over the place and a ton of names down 80, 90. Yeah. I don't know. This is surprising. I think it's fairly in line with what you would think it would be doing. If you had all of the high tech names, and you just saw their drawdowns, what do you think crypto would be doing? You think it would be up?
Okay. The only reason why it would be surprising is if you got into it thinking that it was a currency or thinking that it wasn't at all susceptible to what goes on with other risk assets. So there are those people exist. Those people exist. Yeah, you're not one of them. Okay. I'm not one of them.
Okay. I think most people getting into crypto are not complete fools. They understand that it's volatile.
Okay, so why don't you tell the president of El Salvador that? Because I don't think he thinks he bought a tech stock. Do you?
I don't want to speak for the president of El Salvador.
Well, what do you think he thinks he did? He thinks he adopted an alternative currency. He doesn't think he bought the fucking NASDAQ, but he basically turned his country's currency into the Qs. So
he bought the NASDAQ with leverage. I don't know.
I'm just telling you that's literally what this gentleman has decided to do.
That's poor planning. Come on.
No. Poor planning is when your dad makes you go to LaGuardia 6 hours before your flight leaves just in case. This is some other shit. Anyway, okay. It's bad. Going? It's bad, but it's not just in crypto, obviously.
Actually, we're not going anywhere. Throw up this Cullen Roche chart, Josh. $35 trillion in global market value erased, not transferred, erased. Not into yen or bullshit you're talking about, gone.
Oh, so explain how cash balances are up.
It's not dollar for dollar. Of course they can go up. Yeah, people sell and go to cash, but it's not $14 trillion out of risk assets and $14 trillion into cash. Most of it doesn't come out. It evaporates. Chart back on. Okay, but this is the interesting part. So 14% of all global wealth is gone, including the $1 trillion estimated loss in crypto. 2008 was a 19% decline. So how are we already 3/4 of the way to global wealth destruction as we were in 2008? Chart off. Why? Bonds.
Ooh, I wouldn't have thought of that. I was thinking something else.
I was going to say
the market peaked in 2007 at like 16 times earnings. I was going to say valuation. We started so much higher before. We started at 24 times earnings. Do I have that right? Like, where did the market peak at in November? How high was it? 22, 23?
I thought it was a little bit higher, but whatever.
Yeah.
You're saying valuations were higher in 07?
I honestly think the trailing 12 months PE ratio for the S&P 500 in the fall of 07, just before the crash of 08, I think was like a 17 multiple, because remember, it was being driven by banks and oil companies, and those stocks never traded 40 times earnings or whatever. You know what I mean? So I think I would have said valuation could explain why, like, we're not even in a recession yet, and so much damage has already been done in the market. But I don't know. Tell me the bond hypothesis.
No, it's not a hypothesis. That's bonds. Global bonds are down 10% on the year. So that's
Good
trillions.
Good thing we all got the cash for those bonds. Okay, go on.
Yeah, exactly. Okay. Normally, if somebody would give you the economic data 12 months hence, there's not really much you could do with that in terms of an investment thesis, right? Because, there's just a gazillion variables. Right now, the only thing I think you need to know is inflation and then probably unemployment. So if you gave me the inflation number in December and unemployment number in December, I think I could tell you if stocks are up or down. Like with decent confidence.
This coming December's inflation data.
Yeah. If you told me inflation in December was 4%, I think stocks rip, obviously. No? If you tell me that inflation is still 6-7% in December, I think we're much lower.
What if I gave you? But don't you want the path to how we get to 4%? Don't you want to know if we hit 12 first?
Well, I think that's unreasonable, but fine. Yeah, sure.
I do too, but I'm just saying, I probably wouldn't have guessed 8-point-something% 2 months ago either. Keep in mind the data dependent Fed was telling us as recently as last fall that they were going to do one rate hike this year. So, I kind of feel like you don't just need the number, but you kind of should have an idea of what the pathway to get there is before you conclude that stocks would be higher than where they are today.
Hey, throw up this chart of the IPO holdings. Look at the year to date. It's hard to see, but you don't need, it's all red.
This is the Renaissance IPO ETF top holdings.
So,
oh no, this is in the order of the biggest year-to-date declines.
Yeah. So look at a firm, for example, down 70 billion%. Let me ask you something. Did this come out of a firm and go into gold?
No.
It's a wash.
It went in, no. It went into ConocoPhillips. Felix Salmon is talking about that this is not a fun environment for billionaires. Even the richest man in the world can start to feel constrained after his wealth has fallen by an astonishing $124 billion since early November. He's obviously Elon Musk. Elon Musk is down $124 billion since November,
that's like a Bill Gates.
Of course, that doesn't make him poor, but it does make him say, "Do I really want to pay $44 billion for Twitter?" Which, if I wasn't trying to buy, would probably be an $18 stock today.
His bullshit is such bullshit. Oh, my God.
Oh, he's so full of shit because in his reasoning for why he wanted to buy Twitter, it was to defeat the bots. Now he's saying, wait a minute, there are bots here.
Come on.
I give him credit. He should not pay.
Well, Matt Levine's been all over this. No, of course he shouldn't. He should because he said he signed the contract.
LOL.
But Matt Levine's like, Twitter has to literally take him to court. Like they have a case. Are they going to win?
He wants them to. He loves this. First of all, whatever he decides he wants, if he wants to get out, he'll get out. And if he doesn't want to get out, he just wants to pay less, that'll happen too. You could take him to court all you want. You think he minds spending money on lawyers? You think he's not going to enjoy it? Honestly, he's not going to lose here. So I think he's doing the right thing because of how much the environment has changed from the moment he struck a deal to now.
The right thing is you made a deal, honor your deal.
I don't mean the right thing ethically. I mean the right thing in Elon's universe is to now he has these people over a barrel, beat the crap out of them.
Twitter's a $20 stock, absent what he's doing.
Just look at Snap. Just look at anything in that category. What's gone on in the last month or so, and it's obvious that this thing is not worth $54. Okay. Was there anything else we wanted to say on this? You did the Cullen chart. We got to touch on tech startups because this is another area where billionaires are overly indexed to, and this is just getting started. Yeah. So, real quick, many big money managers have fled startups. Venture capitalists are steering clear of high valuations and demanding companies spend less and improve their margins. An about face after years of profitability taking a back seat. The pressure combined with uncertainty over where the next check will come from has prompted startups that seemed to be soaring just months ago to fire staff members, cut spending, cancel projects. This is a proper correction, the end of a cycle. This is clearly not a speed bump. So this is another area where people were able to take 100 million and turn it into a billion just by being around. And it's now that process is playing out in reverse. And it's not that none of these companies will ever be worth anything. It's that likely the next 12 months will not be very much fun if you've already fully committed to venture as an asset class. It's just not. It's going to be hard decisions and firing people and recaps and insider rounds.
You saw
and down rounds.
Netflix just laid off 150 people.
Right. So whatever you're seeing in the large cap, high quality growth stock space, expect probably 5 to 10 times worse in the private markets because they just don't have the same wherewithal to keep spending what they've been spending. And quoted in the article, what I was really surprised by, there are so many private companies that have hired like thousands of people. I don't think that was common in the last boom for Silicon Valley to have, like, forget about the unicorns, but to have a company with thousands of employees pre-IPO, I think is extremely rare. And so we're going to see what that looks like, unfortunately. And it's not going to be a lot of fun, and it's a lot of billionaire money on the line. And some people are going to have to get ugly, I think, to protect their capital. That's the story there.
There is time. It's time to revisit the Relentless bid, Josh. You wrote this post when?
12,
20,
15.
Really?
14, yeah.
Oh, my
24.
gosh.
I'm gonna guess 2014.
Wow.
I don't know. Maybe somebody will correct me in the comments.
It's been like 8 years. Okay.
Yeah.
So why don't you explain what that idea was?
Just the idea, the question back then, and for a long time before and since, was why are the bottoms V-shaped? Why does the market come back faster than it's ever come back? And obviously the Fed was like a very obvious, satisfying answer, but I attributed a lot of it to the business model of Wall Street moving from brokerage to fee-based asset management. And so the idea behind the Relentless bid was with more and more investor money being overseen by financial advisors and planners versus brokers and traders, with every dip, advisors would be quicker and quicker to rebalance or put excess capital to work in stocks because we're all looking at the same actuarial math. Wealthy people are living into their 80s and 90s regularly, and rates were low, and there was just no way you weren't going to buy stocks, almost no matter what was going on in the market. And that really worked, I guess, for 8 years or so, and this year seems to be one of the biggest challenges for that idea. 2020, it worked like a charm. People couldn't wait to buy stocks, so we'll see what happens. But
I think.
Go ahead.
I think the Relentless bid will still be in place. I don't think regular people who are contributing to their 401ks every 2 weeks are going to stop anytime soon, regardless.
We
of
know
what the
they
market
won't.
does.
We know they won't.
They're not. That's not going to happen. But I do think their ability to dampen declines. I think that might be over.
Why?
Because
their ability or their willingness. Let's start with that.
Neither. No, I don't think that they're going to. I don't think they're going to stop contributing for the next, forever. I think that's
they're no longer big enough to dampen declines like they were able to in 2012 through 2021.
My point is this: I think if you just have a pie and you say, obviously there are other factors like earnings growth, right? That's a huge factor. But I think the Fed is much more powerful than the Relentless bid. I think is what I'm trying to say.
Oh, I would agree with that. And actually, I think that's one of the roadblocks for the stock market getting back to the 2021 high. Is that,
in other words, the Fed
there are new alternatives in town.
The Fed is just so much bigger. So let's give the numbers. All right, and it's funny because I was reading this article from Dave Nadig, and I was thinking like, oh man, that would be a good topic for Tuesday. Let's revisit the Relentless bid. And then he mentioned you as I was reading that. So Dave said the 2019 data. So we're estimating like what are sort of passive flows, about $570 billion a year. And the implication based on a paper that talks about the inelastic market hypothesis is that translates into something north of $2.5 trillion in price impact, measured as the overall increase in market cap a year. So Dave said that number is absolutely wrong, but it's directionally correct and likely has the decimal point in the right place.
But I don't think what you're explaining is that that's the money that's hitting the stock market, whether through active management, passive management, it doesn't matter. That's inelastic in as much as it wants stocks. It doesn't care as much, do I buy Tesla or Ford? It's coming into the market via market participants, and it's driving the price of stocks higher because it's the impact of that money hitting.
And this is like a bigger, deeper discussion that I don't think anybody could solve. But I think that there is definitely something to the fact that 80% of the flows are too passive at this point, right? Like people just aren't allocating money to active managers. And I do think that it has an impact on the market. I don't see how it couldn't. I'm not saying that there's any alternative, that you're better off in like obviously I'm not saying that. I just think it is what it is. I think it's hard to refute.
Well, the real takeaway from this for me came at the very end. This is Dave Nottig's actual words. There is one overwhelming truth that's difficult to get past. In 1978, we as a country decided to outsource retirement entirely. Yes, Social Security still exists, but ever since 1978, almost every piece of public policy has driven the ability to survive in society after the age of 65 into the hands of the individual with a single tool set, the market. We codified and recodified and re-incentivized corporate America and the individual to plow money into the market, from George Bush's ownership society to Obama's My IRA attempt. We collect right. I've been saying this. If you're not in the stock market, you literally cannot live. So
read the end of it. I thought the end of it was good. If capital allocation
is being done wrong, as the conversation between Elon Musk and Cathie Wood suggests, meaning too much passive, it's absolutely baked into what America is right now. George Bush's ownership society on steroids. It may or not be worse than Marxism, but it's unquestionably American. If you don't have an investment portfolio, you cannot live after the age of 65 unless you're living off somebody else. Fact. This is the way we did it. We did it that way on purpose. We don't have the pensions. We don't have the defined benefits anymore. It's all about how much you were willing to put at risk and how good or bad your decisions were while you were doing it, starting from your 20s. The good news is people with 401ks are using them, and 401k balances are booming, largely because of my relentless bid hypothesis. But whatever, that's the good news. The bad news is we need to expand the pool of people who have access to the ability to save in these vehicles, and we need to, I think, further incentivize small business owners to give access to their employees. It's a sin how few companies that can provide these plans actually do. And I understand it's a pain in the ass. It's complex. I work in an industry where there's high employee turnover. All the reasons I get, but still,
I think your relentless bid hypothesis was an instant classic, and I think it can never die. But its ability to impact the market will diminish. That's
you could be right. You could be right. I wouldn't disagree. Stagflation. You read Jason Shu's LinkedIn post that I linked to?
I read this one. Yeah, it was great.
This is good, right? It was super bearish. Super bearish. Jason Shu is basically saying the Fed is damned if it raises rates and damned if it doesn't, and that we are going to have stagnant growth and high prices no matter what. He is firmly in the stagflation camp, and we know Jason. We've had him. I think we've done content with him, right? We've had him on something over the years. He's great. All right. This is him. For the foreseeable future, inflation will remain intransigent, and the Fed's efforts will be futile. Slowing demand by hiking interest rates will have little impact on high prices. It doesn't matter how much demand is slowing. So long as the cost of inputs remain high, prices on shelves will remain high because nobody is in the business of selling for a loss. In the meantime, we'll all experience the unintended consequences of continued rate hikes. Asset prices will decline automatically as discount rates rise. This will create a meaningful negative wealth shock, which we've already seen. The high cost of capital means less investment. We have a glow. All right, fine. It's super bearish. What are your thoughts?
I thought, it wasn't a pleasant read, but he makes some good points. I think I'm kind of with him, particularly on this point. Here's where I'm with him. and I'm sorry that we're both reading him, but he said the forthcoming global stagflation, where growth stalls and inflation is high, will be a never, quote, never market condition that is unprecedented for this generation of U.S. investors and policymakers. You're damned if you hike rates and you're damned if you don't. So what does this all mean? It means a prolonged period in the United States of policy bickering and finger pointing. Our politicians and central bankers have never dealt with this before. They don't have the answer, even if they have to promise a quick solution for the sake of politics. The result will be economic molasses. Unfortunately, I think it's going to get ugly. Like politically, all of the shit that we've seen in our country over the past few years, I think is going to get louder if inflation doesn't come under control.
Because if the Fed shoots a shot and it does what it thinks it can do, and that doesn't work, then it's in the hands of fiscal policy. These people can't. But that's bad because the two sides of the aisle can't even agree on what fucking day of the week it is. They only score points with their party if they disagree with the other party. Both. Okay? Maybe the Trumpists are more obvious and obnoxious about it, but both. How are we ever going to create the types of policies and get everybody to agree, hey, we have to do something? We really, the Fed has been like wallpapering over the instability that we have in government. And they've been doing their job for them.
I still think people are sort of in denial about where we are in the market cycle. Like, if the bull market ended, it just ended. We are obviously going to see new all-time highs at some point. The bull market will resume eventually. I'm positive about that. But it might take like a year or two, or maybe even 3.
I don't think that we're in as much denial as you think we are. Let's pull this chart up. I guess this is from Savita's group. This is the B of A Global Fund Manager Survey. Shout out Savita Subramanian. Stagflation expectations now. This is among professionals, global portfolio managers.
Who are always right.
No, but they're like they always herd into popular ideas.
All right,
but,
so do we.
Yeah, so does everyone else.
Yeah.
Stagflation expectations are the highest since August of 2008. So not since. By the way, people don't realize what was going on in August 2008. Before Lehman Brothers blew up in September, we had massive inflation, but it was the tail end of the construction boom globally that was causing it. There were cranes in the skylines in cities all over the world. You couldn't get iron and steel and the materials to build things. That's where, and oil almost went to $200 a barrel. That was like almost like an emerging markets driven phenomenon. But we had massive inflation, and they were thinking stagflation then. Little did they know we were about to have a depression, not stagflation. But it's notable that 77% of professional fund managers are now in the stagflation camp. So I don't know that there's as much denial as you think there might be. However, to back you up, people don't even understand that a lot of people are using the 2002 analogy for this coming recession because tech stocks blew up both times, which I kind of understand. People don't realize we didn't even start the recession until March 2001. The NASDAQ topped in March of 2000. You had a full 12 months of crashing stock prices before the country even caught the disease. And Main Street actually fell into recession. So to your point, Mike, if we topped January 3rd, it could be a long time. If we're gonna have a recession this time around, it could be a long time before we.
But I think it could be like a stock market recession.
Yeah, it is.
Where the economy holds up relatively well. But speaking of stock market, all right, and the survey, allocation to technology fell 23% month over month. That's crazy. To 12% underweight, the largest underweight since August 2006. Current reading is 2 standard deviations below its long-term average. That's nuts. How quickly people turn bearish on tech.
Yeah. Well, price action will do that. So is that a buying signal? Is that a buying signal?
Probably short term. Fund manager survey, extreme bearishness, highest cash level since 9/11. Biggest tech short since August 2006.
Yeah. Well, look, we could look back on this and say, holy shit, was that a buy signal? Or if you follow the August '08 example, the economic concern was indeed warranted, and it wouldn't take long for it to spill over and become a full-blown economic problem.
I could see like we don't have to. The market doesn't have to go down 40%, but we could easily see a couple year period where it's just a lot of chop and just general pain in the assness, like we saw in 14 to 16. Just a lot of sideways chop and angst.
The Nasdaq at its worst point last Thursday was down 28%.
Okay, it's pretty bad.
Okay, so
it's pretty bad.
So if in 2 months it was down 40%, would things be materially different? Like, would anyone feel any better than they feel today? Or feel any worse than they feel today?
Way worse.
You think so?
Oh,
another 10% from here?
It's not 10%. It's not 10%. It's way more.
Well, from here it's not, but I'm saying another 10% off the top.
Okay, it's bad. It's bad. All right, I thought this was really, really insightful. Let's zoom out a little bit because we're getting a little bit gloomy. Value Stock Geek tweeted, "Here's what matters for different holding periods. Less than a year, nothing matters. Literally anything can happen." So true. Over 5 years, it's 50% starting valuation, 50% business performance. At 10 years, you're talking about 20% starting valuation, 80% business performance. And at 20 years, it's all business. I thought this is a really, really interesting way to look at what impacts individual stocks.
I have never heard it framed this way, but I really loved the premise. I don't agree with it.
What would you take umbrage with? You think it's directionally right?
I think it's missing the most important thing. Industry. Okay. Industry might actually be more important than business performance. I know too.
Okay, fine.
Let's assume valuestockgeek.xls. Let's assume this is a guy that's picking stocks for a living and doing it somewhat quantitatively, or taking the fundamentals and whatever. Let's assume that's his gig, right? Of course, somebody like that doesn't want to come to the conclusion that fishing in the right pond is more important than catching the right fish. But intuitively, we all know that. The best company in the worst sector, stock ain't going to work. So if you come to me, and so here's what I'm saying.
Yeah, but I think what he would say is industry stuff, that comes and goes. It ebbs and flows.
Okay, I would disagree. If you come to me 10 years ago.
You don't think industry performance ebbs and flows?
No, I disagree.
What?
No.
Go ahead.
Sometimes a business just goes bad, period, forever and never comes back.
Industry.
Sometimes an industry goes bad, period, and never comes back. If you came to me and said, all right, 10 years, 20% of what's going to matter is starting valuation, 80% is business performance. Well, I have the best run, best managed coal mining company in Appalachia. Appalachia? I don't know.
All right, listen, I think you're being pedantic because obviously business performance and industry performance are, sort of the same thing. Sort of. You're not going to kill it
all I'm pointing out is something really important is missing here. Something really important is missing here. All right, but then this actually made me go to Twitter and look at the comments. They're exactly what I thought they were. Just like the biggest worst examples of people arguing from extremes. So, somebody being like, okay, how about let's now do Nikkei, now do Cisco, just like the worst bad faith comebacks. I think he's saying something really interesting here, though. I don't totally hate it. And of course, there are extreme examples that would invalidate 20 years, 100% business, of course. But there aren't that many examples. I think overall that's probably true. You figure a great business that performs well over 20 years will be able to overcome most valuations. Not all, maybe not selling 150 times earnings, but the difference between a stock at 15 times versus 30 times won't matter if a business performs over the next 20 years. What do you think about that?
I think that's what he's saying.
I think that's what he's trying to say.
Yeah.
Absent all of those arguments from extremes that people are throwing at him. And I think that's a very reasonable premise. So I thought that was really good.
All right.
Consumer confidence. Throw this chart up. Well, wait. What charts are we using? What is this? Okay.
This is the survey.
Okay. Are the light gray bars recessions?
Yes.
Okay. So is this the worst? Is this the worst University of Michigan consumer confidence reading, the one that we got in May, although that's not shown on this chart. This ends as of April 30th. The May consumer confidence chart is the worst
50?
outside of a recession
By
going
far.
back to 1971.
Huh.
Like literally the worst.
Huh.
Now, why does this matter?
How about this? Well, chart off, please. Guess what? The gray lines can appear. Objects in the rearview mirror are closer than they appear. You know what I mean? The gray lines can appear in 2 months. We might be in a recession.
Yeah. Well, a technical recession where everybody keeps their job would be really interesting. But last quarter, GDP growth was negative. I don't think we're going to have another negative quarter of GDP growth, but if we did, it's a technical recession. It's a technical recession where nobody got fired or not a lot of people got laid off. I would say that's actually not a bad thing to reset valuations for asset prices, but leave everybody's job intact. I'm kind of okay with that.
I think I am in the camp that there's been more damage done to the stock market than the economy, which is obviously preferable to the inverse, right? Where it's like more destruction in people's actual lives. Let's take the pain in the stock market and let everybody, for the most part, not lose their jobs.
Yes. Now, the thing with the University of Michigan survey, it is extremely noisy, and it can veer from one extreme to another, like even inside of a few weeks. It could be hugely different. And I don't know what...
This is all inflation. It's all inflation.
I think so, too. So that was the second thing I was going to say, is that, like, these are readings that you really only get at the bottom of a recession or back in the early 80s, late 70s when inflation was just kicking people's ass. And I think that that's the national mood right now, is just like, you got to be kidding me. I think the average person says, quote, you got to be kidding me 3 times a day. The first time is when they get their coffee. The second time is when they go fill up their tank. And the third time is when their husband or wife calls them and tells them about a purchase they're about to make. You got to be kidding me. That is the national mood right now.
She was telling me about the price of gas. She goes, I put $20 in. It's like $20. You're going to have to put $20 in tomorrow. What are you doing?
How much you think it cost me to fill my Tahoe with 89? Take a guess. From zero. From the light on.
140.
No, not that bad. 116?
How many gallons do you have? I have 22 gallons in my tank. You must have 25, not to brag.
Not to brag. I probably have more than you. No, I don't know how many I have, but whatever. Still, it's a lot.
You have quite a few.
I have quite the gallons. Tank. All right. Home Depot, Walmart earnings. Let me read this. Home Depot, average amount spent per transaction rose 11.4%, while the number of transactions declined 8.2% in the period.
That's nuts.
Think about that. So if prices were static, maybe people would have done more transactions, but maybe 100%.
Not. No, yes, they would have. Well, I guess you can't know, but
you can't really know. But the point is, we're buying less stuff. It's just costing us so much more that it looks like good earnings reports, or it looks like a good, strong revenue.
Net sales were up 4. Did you know how badly Home Depot got the shit kicked out of it? It was one of the better stocks.
The stock's down 100 fucking points in 4 months. It's one of the best companies in the world. I'm just telling you, that's what's meaningful to me.
It was down 30% points.
It went from 400 to 300 to 200.
The stock was down almost 30% today. It bounced a little bit today. But let's talk about Walmart. All right, this is interesting. By the way, so Walmart, chart on. So let's chart on. It had its biggest daily decline going back to literally the day before, the Friday of Black Monday.
Shit.
The Friday of Black Monday. Yeah. How crazy is this?
Oh, my God. We were talking about it on halftime today, and they were like, they had good numbers. I'm like, in nominal terms. In real terms, nobody has good numbers.
Here's all that matters. The president's CEO said U.S. inflation levels, particularly in food and fuel, created more pressure on margin mix and operating costs than we expected. We're adjusting and will balance the needs of our customers for value with the need to deliver profit growth for our future. That's it.
Did you see what this stock price was doing prior to now? This was I think this was a top decile stock in the S&P 500 this year, or the Russell 3000. It was making new highs. It was up almost every day. It was a place people were running out of NASDAQ stocks and into Walmart. It was a staple.
Prior to today, it was down. Prior to today, it was only in an 8% drawdown.
But my point is, it was acting like a consumer staple. It was doing what Walmart should do when people are worried about the economy. That's what's so frustrating about this market. Nothing works.
That's it.
So I was saying, like, how many coins do you want to pump into the slot machine before you realize it ain't never paying out? So if you have stocks on technicals that look as good as Walmart, and it's in the right sector, and it buys back stock, and it pays a dividend, it's like everything that you should do right now as a stock picker, and then it has the worst day since 1987. You want to play another stock tomorrow? Do you really? I don't think you do. Like that, I think that that's very emblematic of the frustration that investors are feeling right now. It's not like things are that bad. The way they're treating these stocks, it's like the end of the world individually.
Walmart was up 6% going on the year going into today. And now it's down 6%. I mean, it just got rocked.
Sick.
Sarah Eisen made a good point. Walmart reports big earnings miss as higher cost supply chains eat into profits. And so Sarah said, the Walmart Carter invalidates Elizabeth Warren and other politicians who blame inflation on corporate America price gouging and padding profits. Your thoughts?
Dude, she added her? She added E. Warren? What are you, crazy? What was Elizabeth? Who cares about my response? Tell me how does that story end? Did Elizabeth Warren go crazy on her? Let me tell you something, young lady.
Actually,
did she scold her?
No, Elizabeth Warren is maybe directionally correct because profit margins in the S&P 500 have been at all-time highs. They're probably going to come down. I don't see how they don't. But profit margins, not only are they at all-time highs, but like they spiked. They passed it all through and then some. Now it's too much.
They're gonna go after these oil companies. Record profits is not a good look with WTI crude at 113 and shortages all over the place. They're gonna go after these guys. I predict one more quarter of this.
So this was interesting. So Jason Furman was writing about this. So retail sales came in good today. He said retail sales are so inertial. It is hard for me to see the U.S. slipping into recession. Cool. But it is also hard for me to see the economy cooling down and inflation moderating either. So what do we do with this? I think this is like the push and pull. And we're about to get into corporate health. But the consumers are in great shape. The consumer financial balance sheet is ready for it.
Furman's a professor at Harvard, so forgive me. But he should have read past the headline. Bookvar did this thing this morning where
he's much smarter than both of us.
Sure. Everyone's smarter than me. Bookvar did this thing this morning where he ran it back to January of 2021, and he took that retail sales line, and then he put it up against the cost of goods in CPI, and it turns out it's a wash. There is no growth. So CPI, so retail spending on goods has gone up 18%, but the cost of those goods has gone up 16%. So this is back to what I'm saying about how like we don't get same store sales and retail sales numbers inflation adjusted. It's a nominal print. And this idea that like, oh, the consumer's strong. No, the consumer has no choice. The things the consumer is buying cost what they cost. There are some substitutions they can make. You could buy the Costco brand, for example, instead of your favorite pancake syrup. But like in the end, the consumer is spending what the prices demand that they spend for the most part. And I don't think we should look at those nominal numbers, those nominal gains in spending and say the consumer's doing great. It's bullshit. Just look at the sentiment surveys. Nobody thinks they're doing great. And so I think that will end up winning out. What's your final topic?
But in terms of like debt levels and stuff and what the consumer is carrying, they are in great shape.
Thank God.
Last thing. Okay. So corporate health. So here's why it's hard to get like too bearish, because the consumer is doing fine. I know they're doing less fine. I get it. And corporations are in rock solid shape. Okay. This is from Herb Silver from S&P. He said, S&P 500 Q1 buybacks record.
Howard Silverblatt?
What did I call him? Herb?
I like yours better. Howard Silverblatt.
Sorry about that.
He's the senior index analyst at S&P Dow Jones Indices.
So he's penciling in a new quarterly record at $287 billion, which would make the 12-month period June to June, $1 trillion. And he said there's a DC headline, right? Imagine we're in a recession and stocks buy back $1 trillion worth of stock over the last 12 months. All right. Also, dividends, also all-time record. And then hold on. Listen, look at these two money charts from Sam Rowe. The corporate balance sheet are the cleanest in decades. You're looking at debt to EBITDA.
Wow.
And look at the corporate, the cash mountain. So are they going to pull back on investment?
Wait,
sure.
stop. Is that 7 trillion, it says, in cash?
Yeah. So it's hard to get too bearish. Just pump the brakes on the bearishness.
How big is the stock market? 35?
35. Yeah, I was to say. Well, maybe 30, 35.
So theoretically, like companies could buy back a fifth of their float, give or take. Not that they should or they would, but I'm just saying, like, that's how much cash there is. That's really interesting. I didn't think it was anything like that. I didn't think it was anything that high relative to overall market cap. Does it make sense for corporates to spend the next 12 months buying back $1 trillion worth of stock? Does that make sense relative to other things that they could be doing with that cap? Well, so their share prices are finally down. So from that standpoint, this would be a good time to buy back stock, arguably a better time than 2021.
Oh, yeah?
Which they bought back a ton of stock
Unless we go into a deeper recession than you and I think, and it's like, how irresponsible. I don't think the risk is worth the reward.
Because they start laying people off. And then everyone goes back and says, this company,
how much? Right, exactly.
Yeah, this company bought back $3 billion worth of stock a month while laying off 10,000 employees. Like it'll be something like that. They're kind of screwed then because they still have to do the right capital allocation. They still have a job to do for shareholders. I guess it's going to vary by sector. So maybe a bank pulls back a little bit.
You're right,
because
Josh,
they have to have reserves.
This is not going to dampen whatever decline may or may not come in the stock market. I'm just saying it might provide some sort of valuation support. If you say, well, now stocks are really cheap, right?
Silverblatt's also saying dividends. Q1 2022 set a new dividend record, $16.35 a share for the S&P 500, or $137.6 billion worth of dividends. And Q2 22 appears on the road to set another quarterly record. I didn't realize the S&P pays out almost $140 billion in dividends each quarter. That is so much money being returned to investors.
A long-term chart of dividends is one of my favorite don't you dare sell charts.
Right. Because the dividend goes up in concert with the stock market, the stock's market cap. Not one for one, but it's on a parallel track. And the only time you really see a lot of dividends get cut is in a bad economic environment.
Yeah.
When the stock price is down a lot anyway.
But that is one directional. Dividends always go up.
Yeah, I think that's fascinating. I'm glad you brought that one in. What's his bottom line though? Given the earnings, cash flow, and a slowing economy, both buybacks and dividends are still expected to post 2022 records. Conditions are expected to put more pressure on buybacks. I'm expecting 1.1 trillion. The amount of dividend increases may also slow later this year, at a time when inflation would historically lean toward higher increases. I'm expecting a mid 8% payment increase in dividends.
Dividends don't go up because market cap goes up. Dividends go up because companies raise their dividend every year.
Correct.
Not every company, obviously, but there are a lot of companies that raise their dividend every single year, come hell or high water.
All right, let's get Duncan in here because we're running long. Where are you?
Hey guys.
Look at this guy.
How's it going?
What's up?
All right, so we have viewer topics tonight. Hit us with the first one, sir.
Wait, hold on, Duncan. Are you about to make a joke? I saw a little.
No. I hadn't noticed Josh's screen name until right before I came on. So
oh my God, me either.
Tether Locklear. That's a good
See
one.
what you made me do? I lost an AirPod.
Oh, okay.
Yeah, why are you this whole show? You're every show you're tweaking with this. Do you need new AirPods?
I might.
Do they not fit?
You never have to worry about that if you wear these.
True. No, I have the pros. I guess they fit. I'm just paranoid that they're gonna fall out, and then they do.
Yeah, I don't think they do.
Mine do.
What's Duncan? What do we
I have
got?
I have a very delicate inner ear, like an inner earlobe. I don't know if you know about that condition, but I have that.
That I don't.
So
Haven't heard of that.
They don't grip. They're like it's like a fragile lobe. All right, go ahead.
Okay.
I don't want to say too much about that, honestly.
Okay. So first up today, we have a question from Locke or Woke. ETFs seem to be holding up very well despite the current market. Is this an indication that there's an ETF bubble? There's been a lot of talk about this in the past, right?
Wait, say that one more time.
They're basically just asking, ETFs seem to be holding up better than the market overall, is what this viewer is saying. And
Here's
so
what
they're
I would
asking
say.
if that's any indication that there is in fact some kind
Holding
of
up,
ETF bubble.
holding up in price or in inflows. I'm trying to figure
We're
out
not
like
talking about
what.
inflows.
So
We're not
this
talking
is
about inflows.
condensed.
They're misinformed, and respectfully,
They
it's
specifically
important.
mentioned dividend ETFs. I should mention, but
Oh,
but
so
it
yes,
seemed like
value
Oh,
looks
Duncan,
better than the
that changes
S&P.
everything.
Well, but okay, but yeah,
Mike-
but they're asking relative.
Mike
to,
almost
to
ripped
the
this guy's
stocks,
head off.
Relative to
No,
the
I
stocks
didn't.
within, it was the point. So I was trying to make it more generalizable because they're asking. They go on to ask if there is an ETF bubble.
Someone's saying that ETFs are holding up better than my earlobes.
Okay. Values.
Delete that comment, please, Nicole. All right, go ahead.
Dividend-paying stocks are holding up well, whether or not they're individually held in a mutual fund or in an ETF. There is not an ETF bubble. It is the most efficient way to access large swaths of the market without taking undue risk in individual stocks.
Yeah, if you have the observation that ETFs are holding up better, but the ETFs you're looking at just happen to own the in-favor stocks like consumer staples and utilities, you're misplacing what's holding up. It's the stocks themselves that are holding up. The ETF wrapper has nothing to do with it. Okay, next topic.
Michael Burry is the person who's talked about that a lot, right? An ETF bubble.
Oh, I thought you said he's the one that asked the question.
yeah. It's from Michael
Yeah,
Burry.
send Mr. Berry a T-shirt. All right, what's next?
Okay, the next one's short and sweet. What percentage of a portfolio should you keep in cash?
Right now,
100.
all.
Duh.
Yeah, 100%. This is a function of really is nothing to do with. There's no like right investment answer. There's no efficient frontier answer when you're talking about portfolio construction, like how much cash. So some would say to base that on like when you're planning to spend the money. So if you have an expense that's coming up in the next 2 to 3 years, all of the money that you need for that expense should be in cash. You really should not be taking the risk that you're going to need that money and it could be down 20 or 30%. Like that's really like more of an issue of like if you tell me this is an IRA and I'm 30 and I'm not using the money for 35 years, you should have no cash in that account. So, Mike, you have a different take than that?
Nope. This is not a portfolio management question. It's a personal finance question. So Josh is 100% right. Where is the money? What is your income? When do you need it? What's your risk tolerance? That's what it's about. It's not about where the market is going or coming from.
Nick Majuli wrote a really good piece about this a while back where he broke down different timelines and where you should be keeping your money.
Yeah, this is going to be really more about you than it is like there's no market answer for that. Unless we take out the fall lows for the NASDAQ, then you want to be fully in cash. All right. What do we do for people whose topics we use in the show? We're sending out the official Compound laptop sticker.
Yes.
That's pretty hot, right?
Yep. Yeah, it's a laptop sticker. Oh, yeah, I should mention, I'm glad you mentioned that. For that second question, we've had a lot of people ask about cash, and we actually couldn't find exactly where that one came from. So if you asked a question about how much cash in your portfolio you should keep, just send us an email and forward us that one, and we'll send you.
How do we send an email to you, Duncan?
It's askthecompoundshow@gmail.com.
Okay, excellent. Good to see you. I'll see you on Thursday. All right. Thanks, everybody, for watching the show. Make sure you hit that like button if you haven't already. Please leave comments. Please share this link widely among your circle. Michael and I want to thank everyone who showed up for the live. Brand new episode of Animal Spirits. First thing tomorrow, the minute you wake up. New Michael and Ben. All right, guys. We'll see you later this week.